So when was the last time you checked your mortgage payment and noticed how much of it was going towards principal versus interest cost? Well, a few days ago, an extended family member of mine broke down in tears, angry and upset. She and her husband recently bought a home 6 months ago, got a mortgage in the process, and since then been making her payments diligently, amounting to thousands of dollars of mortgage payments. But later what she noticed, after making thousands of dollars towards a mortgage, she noticed that her loan balance only decreased by a mere $1,000. And sadly, this caused her to break down because by now she would have thought that she paid off a fairly good chunk because she spent thousands of dollars on her mortgage payment. And I'm talking about a good chunk of her hard-earned paycheck going to the mortgage, yet doing very little to actually decreasing the loan balance. And so how could this be? So in this video, I'm going to show you just how insane mortgage payments are, and the way that it's designed by the banks are going to be shocking to you. By the way, my name is Kwak. I'm one half of the Kwak brothers, certified financial education instructor, serial entrepreneur, and a real estate investor. And my brother and I have been teaching financial concepts and strategies over the last decades that could help you make better decisions when it comes to your financial future. And so by the end of this video, I'm going to show you how the mortgage payments work and the shocking truth as to just about how much interest you're going to end up paying and why mortgage payments, in my opinion, are insane. So with that out of the way, let's go dive right in. And the first thing you need to understand is a process called a loan amortization. A loan amortization is simply a term to describe how a mortgage is paid off in a given time period. By the way, I'm going to try to stay away from any jargons or technical terms and try to keep things really simple and concrete for you to understand. So a loan amortization is simply a way to describe how your loan balance is paid off with your mortgage payments. And in almost all cases, amortization is used in mortgages, car loans, student loans, and in some consumer loans as well. Now, a few common myths that I get when it comes to paying down the mortgage is that a lot of people believe that the interest is paid linearly, meaning equally for the next 30 years, or that the interest is paid pretty much once against the total borrowed amount. So let's say you borrowed $100,000 on a mortgage. Some people believe if you have a 4% interest rate, you're paying a total interest cost of $4,000 for the life of 30 years, which is simply not true, or at least partially true, and I'll show you why that is. So what I'm going to do now is share my screen and share exactly how amortization works and just how insane mortgage payments are. So here I have on the screen, I pulled up an amortization calculator, which I happen to be using Bankrate. Now, this video and my channel, we're not endorsed or associated, sponsored by Bankrate. It just so happens to be a reliable calculator that I found just by Googling amortization calculator. So you can also Google for amortization calculator and you'll find the exact same calculator that I'm using in this video. So feel free to try it on your own. So here we have the amortization calculator. And let's assume for this example, I'm going to set up some parameters. Let's say we are borrowing a $400,000 amount for our mortgage, 30-year for the term, and the interest rate we're going to set is 6.74%. Now, you might be wondering, where did I get that rate? Well, I got this rate from a very reliable source, also known as Freddie Mac, which is a quasi-government agency that helps regulate banks and the guidelines for how banks are allowed to issue mortgages. So Freddie Mac is a very reliable source, and I'm going to go with the 6.74% average fixed rate mortgage right now, at least at the time of this recording. It might be higher or lower depending on when you watch this video. So back to the amortization calculator, 6.74% interest rate. And let's say we're going to start the loan on June 2025. Now, when given these parameters, you can see our monthly payment of $2,592 every single month. And get this, a total interest payment of $533,024. That is just the interest payment alone. So we borrow $400,000, and across the span of 30 years, we're paying back just on interest $533,024. I mean, we could essentially buy another house with that amount of money. It's a lot. So when we couple that with the total loan amount, we're going to end up paying back $933,024 of total payments back to the lender with interest and principal combined. Now, mind you, that $2,592, the monthly payment, does not incorporate property taxes or the homeowner insurance premium. So no escrow is incorporated in that, just the principal and interest payment. And by the time we're done paying this off, it's going to be approximately June of 2055. That's a long time from now, right? It's 30 years from now. Now, if you scroll down, you'll see what's called the amortization schedule, also known as the amortization table. Now, what this amortization schedule shows you is that if you make the same $2,592 payment every single month, how much of it is going towards interest versus principal. And so if we expand down to 2025, to see July through December, and there are two columns, principal and interest. And what this is to show you is how much of your monthly payment is going where. So in July of 2025, a meager $345.07 is going towards principal, and a whopping $2,246.67 is going towards interest. Yikes, right? And I pause right there for the shock. So what that means is that if we're paying $2,592, $345 of that is going towards actually reducing the loan balance, whereas $2,246.67 is going towards the bank as interest. Pretty wild, right? And this stays that way pretty much August, September, October, November, December. And each of those payments we're making throughout the rest of the year, the vast majority of it is going towards interest. And I'm talking about a good chunk of your paycheck, your hard-earned paycheck that you spend time in commute to go work for a company from 9 to 5. You might be dealing with stress or maybe not. You're going through all of that to have a vast majority of your paycheck go towards interest. And this is where you begin to realize why my extended family member broke down in tears, upset and angry at the fact that she's worked so hard for the last 6 months. She couldn't believe how much or how little her payments have actually contributed to lowering the mortgage balance. And the worst isn't over yet. Okay, we go to 2026. Yep, pretty much stays that way, right? Vast majority of the payment goes towards interest. 2027, okay, 2028, 2029, 2030. I'm going to just skip to like 2040. All right. Still in 2040, okay, right? 15 years later, only $961 is going towards principal and $1,630. So still a majority of the loan payment, the mortgage payment, is going towards interest. All right, when does this, let's see, when does this actually break? All right, so in 2045, you'll notice right here, there's a little bit of shift that happens right there. So it's not until April of 2045, our principal portion of the payment exceeds the interest portion of the payment out of the $2,592. Okay, so you have to wait 20 years later, right? 2045, April is when we get to see most of our payments, or a good chunk of our payment, is actually going towards reducing the balance of our mortgage. Pretty shocking. I know. And I know some of you guys might be saying, well, Sam, I don't believe you. This is inflated. This is all fake. There's no way this is all real. If you don't believe me, check your mortgage closing statement. Okay, the fake packet of paper that your bank or lender gave you. Okay, it's in the Truth in Lending Act or Truth in Lending Statement. In there, you will find this exact amortization table, the schedule, to show exactly how much of the principal you're paying and interest you're paying per each of the monthly payment you're making for 30 years. Now, if you have a lower interest rate, say 4% or 5%, you're going to see the kind of the break-even point of when the principal and interest payment equate. That's going to happen sooner. Okay, let me show you how that works. So let's go back to the interest rate and take this down to, let's say, 4%. Obviously, the monthly payment is much lower. We pay less interest, and the total cost of the loan is going to be much smaller. Even with the 4% interest rate, let's say in July 2025, still, okay, only $576 is going towards principal, and $1,333.33 is going towards interest. So still a majority part of your monthly payment, even at the 4% interest rate, a majority is still going towards interest. And the break-even point really happens, let's see, not even 2040, like 2040, yep, go to 2034, then to 2035, somewhere around here. Okay, right about in 2037, or 2038, I should say. All right, here we go. March of 2038 is when there's a break-even point where now principal portion is much higher than the interest portion of your monthly payment every single month. Pretty scary, even with the 4% interest rate. So it's not until what, like 18 years later still that vast majority of your monthly payment is going towards interest costs, not to lower the balance. Now, you might be saying, Sam, how is this aligns it this way? Like, how is it that we're not able to pay more in principal? Well, you can by making extra payments, or you can use a strategy that I recommend, accelerated payoff strategy. So you can make extra payments that will result in lowering the loan balance, which will then accelerate how fast you pay this mortgage off and the cost of interest goes down overall. But the answer as to why interest cost is a lot higher than the principal payment itself in the beginning, I'll show you that in just one sec. But for now, you can also look at the table in a graphical form. So you can see that this green or this line color line represents the amount of interest you pay in aggregate. And the slightly lighter blue shade line represents the principal you pay in aggregate as you spend paying down this mortgage. Now, a better version of this graph is this. This is kind of my more of a favorite version of it, where it clearly shows you the orange highlighted area represents the amount of principal you pay per each monthly payment, whereas the green or the line color represents the interest you pay per given monthly payment. So at the very beginning portion of your mortgage, you'll notice, and this is broken down in percentages, 70% of your mortgage payment is interest cost and 30% of it is principal. And as you progress in paying every single month, more and more of your monthly payment does go towards principal. So the ultimate question is, why is this the case? Well, the simple answer that I can give you, the most easy kind of one-liner answer, is because your loan balance is at its highest in the beginning of the loan. Pretty simple. I mean, it's rather obvious, but it has to do with the calculation of interest cost when it comes to the loan. So let me show you how that works. We'll get a little geeky here, and I'll try to break this down in the most simple way possible so that you guys can really understand. So let's say in January, okay, to make things simple, we start out with a balance of $400,000 on our mortgage. And let's say the interest rate's 4%. So the way that we calculate the interest cost for January is we'll do 400,000 times the annual interest rate of 4%. Okay, we'll do this first. Divide that number by 12 because there's 12 months in a year. And that gives us the interest cost for January itself. So let's do the math real quick. All right, 400,000. All right, I got the interest cost of $1,333.33. All right. So that is the interest cost for January alone. And the principal portion of the payment is really calculated depending on the length or the amount of years you pay down the mortgage. So the longer the amortization, like 30 years, the smaller the principal is. The shorter the amortization, let's say 15 years, the bigger the principal payment is. So it really depends on the length of the amortization. We're not going to get into the depth of that because it can get pretty complicated. There's a lot of formulas that I don't want to bore you with. So just know that it has a lot to do with the length of the amortization. Well, let's say February rolls around, and because we made some principal payment, let's say our balance goes down to, let's say $395,000. And then it's not going to be that big of a drop in a single month unless you do a large extra payment. So we're going to do the same math. 395,000, okay, times 4%. All right. And we divide that by 12, and that gives us $1,316.67. Okay. So you'll notice, right, depending on the balance of the loan for that specific month, the interest cost changes. All right. So that's how the interest is calculated on a mortgage. It takes the annual interest rate divided by 12 months. It gives you monthly interest rate times the monthly balance or the month's ending balance of the mortgage. That will give you the interest cost. So when the mortgage balance is at its highest in the first 5, 10, 15 years, this is why you see a larger cost in the interest, whereas the principal portion is going to be much smaller. Now, if this were to be, let's say, a 5-year loan, you're definitely going to see a much higher, significantly higher principal payment but it also results in a much higher total payment overall. You can see a higher monthly payment. And in that case, where the loan might be 5 years, the principal portion of the monthly payment is going to be actually much larger than that of the actual interest cost. But in the case of a 30 years, because you're spending more time and paying it off, you're going to see a smaller principal reduction over time. And you're giving basically a mortgage more time for the interest to accrue every single month for the next 30 years. This is why you see this crazy number where the interest cost is a lot higher than the principal portion of your monthly payment. So friends, I hope that explains how the mortgage payment works and why even after spending 5 years of paying down your mortgage, you're really not seeing much of your mortgage payment or mortgage balance drop. And that all has to do with the amortization process and the way it's designed. But what if I told you that this isn't the worst part of your mortgage? In fact, there's something that I like to call the 2 mortgage traps. And the way it works is it traps you in the first 5 to 10 years of your mortgage, pretty much for the rest of your life. And because you're trapped in the first 5 to 10 years of your mortgage for the rest of your life, really most of your mortgage payment does nothing but to pay interest. So if you were interested in that video, check out this video right here. You'll see the worst part about how your mortgage amortization works and the way it works to trap you in the first 5 to 10 years of your mortgage. So definitely click on this video and check it out, and we'll see you in that video.